Hi and welcome to Erik Penser Bank. My name is Jonas Thulin. I'm head of asset management here, and I will shortly go through our house view, and we will stick our necks out this week because we will take a different view and a different argument than what I would guess and believe that you heard quite a lot in terms of the downturn in the equity market in January, which I would bet about 90-95% of pundits out there are arguing is correlated or it has to do with CPI or rates. We take a different view. We do not dispute the fact that equity markets are down, but also the equity markets turned around the day after we highlighted the trough in the equity market. And there's a reason why we highlighted that trough on the 24th of January. And the reason is not that the CPI pressure all of a sudden has disappeared or the rates have all of a sudden disappeared or changed direction. Our reasoning is that it's I shouldn't say a misanalysis, but I think that an analysis that depicts the relationship between CPI priced progress or development and the equity market is pretty tough to come around. And I would try to show you a bit more what I mean with this, because I know that we go a bit against the consensus. Because we have stayed rationally calm. We do not buy into the argument that the CPI pressure has led to falling equities in January. We do not buy into the argument that it has to do with rates. We do buy into the argument that it has to do with, again, a lot of gamma positioning and a lot about political risk. Now, I will skip the Swedish central bank. That's like watching paint dry on the wall. For those who are interested, a reason why we stick to short SEK is that a lot has been priced into the rate market, despite the Riksbank's forecast, of course being driven by Bank of England, ECB and Fed pricing. But we will stick to our short SEK position because we think the market has to adjust on the downside, which is, as you can see in history, quite often the norm. Now, critical elements of CPI. Because if you believe that CPI was it's a pressure from CPI market, why did the market all of a sudden trough? The reason is I think that's the wrong question to begin with, because as a matter of fact, if you look at break-evens, like 5 years, we're back to levels that we were in 2021. There is no increased pressure here in January. Hence, you cannot point to 5 break-evens and say, oh, it's been a tremendous pressure from break-evens, that's why the equity market has rolled over. As a matter of fact, it's vice versa. You could point to the fact that, the price pressure has decreased, hence the equity market should rebound as soon as we get rid of the gamma exposure, which happened right before the weekend, before the 24th and 25th of January. Which was a perfect trough in our sense. So in terms of break-evens, you have a little bit of a, I don't think the statistics actually make sense making that argument. The other factor is that obviously that commodity markets also turned around quite aggressive from Q4 last year, going in for lower and lower headline CPI. 5 forwards, the same thing. And if you add priced inflation expectations, you can see that you have, even there, a small downside tilt to the CPI, and actually then lower inflation expectations, traded inflation expectations in 2022 in January. So that means that if you look at inflation expectations, you look at break-evens, or if you look at inflation swaps, you can actually see a lower CPI pressure in January, which of course does not explain at all what has happened in the equity market. On top of that, we can see that supply bottlenecks are dissolving quite rapidly. You can look at it from various angles. We have Kansas Fed, we have the Mid-American PMI, you have the New York Fed's chain pressure index. They're all indicating lower bottlenecks, or I should say a better or solved bottleneck situation in the US, leading to lower CPI. You can throw in Baltic Dry Index, you can throw in harbor activity, you can throw in regional service for all the Fed regional offices. They all indicate that you've seen the peak in terms of supply bottlenecks, which corresponds to lower inflation expectations, inflation swaps, break-evens, etc. Again, not at all fitting the narrative of why equity markets were all of a sudden weak in January of 2022. Now, we can add on this, I'm skipping a few slides here, but they're more the same message really. You can look at ISM or commodities, you can look at Chinese money supply, you can look at Cleveland, CPI expectations, you can look at money velocity. all over the chart, you can see lower inflation pressure. And if we really want to put our necks out there, you can even see it from the wage growth. I.e., we know that today's wage growth is high. We can do a PCA analysis and say, yes, it is climbing. But we can also try to front-run the PCA analysis by looking at the underlying developments in the wage data. You can actually see a little bit of a runoff or even a slower with a negative sigma. This is a historically interesting chart. We haven't quite finished our work on this yet, but I think it's pretty interesting to see that this corresponds, again, what was being priced in the CPI traded markets. Again, not making any sense whatsoever to the falling equity market in January. Now, for us, the falling equity market in January was all down to a negative gamma, and that expired on the 19th. Hence, on the Tuesday after, the 25th, you per normal get a rebound. And I'm not really sticking my neck out saying this. This is the 8th month in a row this happens. So we have 7 months of history, perfect history behind us, which makes that call being quite easy to make in that sense. And we shouldn't confuse that with all of a sudden something happened in the CPI market. This is all a story of gamma and another factor that I come back to. And when we look forward, we can actually see positive gamma for quite a while, which is positive for the market. Now for us, the leading culprit here behind the equity downturn in January was the fall off or the rolling down in political risk. Now we see a trough and it's going to improve again. Now this has statistically, I'm going to see if I didn't bring that chart, but statistically if you look at 30-day back or 15-day backs, you can see that political risk explains between 80 and 90% of the equity move. If you look at the CPI or rates, you're down to 0.6. If you look at all of January, if you look at the last 15 trading days, you're down to 0.2 in explanatory power, which is really weak. Hence, statistically, you will not, or you sort of lose in that sense if you stare at CPI or rates and miss political risk. And on top of that, if you miss the gamma exposure, I think it's very hard to understand why the equity market bounced. For us, when we look at this and we look at the CPI and when CPI is moving, i.e. peaking, we are more and more constructive, and that's why we hold on to our strategic overweight in equities rather than shifting and being underweight. Now, this is all also captured by our trading model, and this is a really nerdy one, but we go deep into the market and look at the alpha component in the FX basis. We look at the vol curve in terms of forwards on the VIX curve. We look at various other fixed income spreads, i.e. secured, unsecured bank loans. And you can see this black model, which shows an upside in the equity market. And then we just have to wait until the option market expires, and we can sort of catch up to the rest of the markets. Or vice versa. You could make the argument that the equity market is right, and we're going to have a tremendously more difficult environment going into financing, counterparty risks, liquidity, etc. That might happen, but we will not trade that until it happens. So our argument is to remain calm and try to be cool in this sell-off and find the underlying explanatory powers which are residing in political risk and the options market, not to be confused with the fact that the CPI market has not explanatory power. And on the other hand, if anything, you have an upside from the equity market looking at the lower priced CPI going into through January. So I believe that was a short update from us at Erik Penser Bank, and I will be back in a week and see how it all fared out.